Welcome back to the Finance Capital, where we make money talk make sense. For teens, by teens, I'm your host Jasraj, and today we're diving deeper into the world of investing. If you have listened to our previous episode, Investing 101, this is going to be the next level. We are unpacking some powerful tools and strategies today. How to research a stock, understanding dividends and capital gains, getting the lowdown on Roth IRAs, and why diversification is your best friend when it comes to minimizing risk. Joining us today is Mr. Chadda, a investing pro, who is going to help us break down all of this. Welcome to the show, Mr. Chadda.
Oh, thank you for having me. I'm happy and delighted to be any help to children.
Great. So let's start. Where most investors get stuck, researching a stock. It might sound intimidating, but it doesn't have to be. What was your first thing a beginner should look at when trying to evaluate a stocks company?
Okay, stock company, when you start to evaluate, there are many factors that you can look at. Most advanced would be like a beta or some Greek nomenclature, but forget all those. As a beginner, you should look at like a PE, which is called price to earning ratio. The other key factor would be PEG, which is price to earning over growth. There are many factors which you could use on if you Google it, you can see it and look through Yahoo Finance or some other websites.
Yeah. There are many tools and platforms to help analyze stocks, like as you said, Yahoo Finance, Google Finance, even apps like Robinhood or E-Trade give some basic data. So can you please walk us through some key metrics like what exactly is the P/E ratio and the PEG ratio, and why should we care?
Okay, P/E ratio defines P is for price, E is for earning. So it's a ratio which is price of the stock divided by earning per share. Overall market is like approximately 18, 19, 20 PEG PE ratio, which is like if you take all the stocks of the Dow Jones or the stock market or S&P 500, the PE ratio runs about 18 or 19 traditionally. So if PE is, let's say, 30, so that means stocks are overvalued. If the PE is about 10 or 12, so that means stocks are undervalued. But that alone, PE alone, does not dictate is the company is good or the stock is good or not. The reason being, when the companies are growing faster, when they're in the beginning, their earnings are exponential. So PE ratio could be very, very high, 70 or 80 also. So this is where you look at PEG, which is called PEG ratio or the PE growth ratio. See how fast the company is growing, the earning power. So it's okay to buy stocks which are higher PEG, higher PE, but they're growing at a rate which is much faster than the market. There are also stocks which are very low PE, like for example, utilities or the housing or the banking or the financial. They are run typically under 10 PE. So you would think under 10 PE compared to Microsoft or a Google or something like that is 26, 25 PE is a good bargain, but you need to focus on the industry, what the industry looks. So basically in this case, the industry is saying that it is very kind of saturated, the growth is not much, whereas somebody like technology, newer technology can grow very fast, and this is why the difference in PE and the PEG ratio.
So if you're listening and thinking, this is a lot, just know, start with one company you like, look in what they do, read their earning reports, and see how they've been performing over time. Now let's talk about something most teams don't even care about and don't even know they can have, a Roth IRA. Firstly, what are Roth IRAs and why are IRAs so special for young investors?
Okay, so IRA meaning individual retirement account, and Roth IRA is a form of IRA. Roth was started in early 2000, and there are some key differences between both IRA and Roth IRA. These are the tools government made so that you can in your golden year or in your retirement year, you would have funds available to withdraw and use it. So let me tell you first about IRA. IRA is you can contribute to IRA, and every year contribution varies with your income level and varies with your age, and varies with what you can contribute. So IRA contribution up to certain limits are tax deductible. So if you're earning, as a high-tech individual, if you're earning, let's say, 100,000, then there's a certain amount of money you can put in IRA without paying taxes on it. So the money grows, along with IRA wherever you invest it, and then you can withdraw it at the age of 49 and a half onward. There are some rules when you can withdraw, when you cannot withdraw. But for short term, imagine that you're putting money for your golden age, for your safety net. That is IRA. So IRA money is after tax money. What is Roth IRA? Roth IRA is different kind of animal. It is a tax after tax money. So the money that you put in Roth IRA is after tax. So you have already paid taxes on it. So then you say, if I already paid taxes on it, why should I invest in Roth IRA? But the beauty of Roth IRA is the growth that occurs is tax-free. When you withdraw the money from Roth IRA, it is tax-free withdrawal. So it's significantly different than IRA, because IRA money that you put in is before tax. So whatever you withdraw, you have to pay taxes on it. Whereas Roth IRA, you don't have to pay tax on it. That's the basic difference between both two.
That's right. Roth IRAs are funded but with post-tax dollars, which means your money grows and you won't have to pay taxes on it later. And when you're young, time is your superpower. So Mr. Chadda, can you please explain how compound interest plays into all of this?
Okay, compound interest is like a magic, I'm sure you heard of Einstein.
Yeah.
And Einstein says it's the eighth wonder of the world. Compound interest is phenomenal. If I tell you a simple story, like let's say if I give you $1 million, and if I give you a penny on a chessboard, and every time you move it doubles, which one would you prefer? Would you prefer 1 million, or would you prefer a penny which is put in the first square of a chess block, and then every square it doubles and so on and so forth till it reaches 64?
I'll prefer the chessboard.
You'll prefer you're a smart boy, because that is kind of compounding information. So compounding grows like wildfire. It is exponential growth. There are many examples of compounding. So I highly recommend, using compounding methodology. And how it is used in stock is very simple. So stocks pay dividend or capital gain. If you reinvest it, so then it's compounding. And if you just keep the dividend or the capital gain, you withdraw it, then it is not so it is not compounding. Sorry.
Yeah, that's fine. So if a teen starts with investing just $50 a month at 16, they can become a millionaire by retirement just by staying consistent. Wild, right? Now let's
Yes.
break down to two ways we can make money from your investment. Dividends and capital gains. I remember how you were talking about dividends and capital gains a bit on the compound interest. So let's start with dividends. What are they and how do they work?
Okay, dividends, when the companies, like remember I told you first, the early phases of the company, the PE can be high. So those companies are earning money, but whatever money they're earning, they're putting it back in the companies to grow. The companies with lower PE ratio typically are the more matured company. They're earning money also, but what they do is instead of putting it back, some they put it back, but mostly what they want to do is they want to reward the investor. So whatever earning they make in a quarterly basis, the part of that they return to investor as a return. So that is called dividends. So typically utilities companies are very famous for paying the dividends, and the retired people, they need a constant source of income in addition to Social Security or 401k, as we talked about it, Roth IRA, and so on and so forth. So they use dividend paying company because the company, from their earning, they pay small amount to the investor, and that is the dividend part. The capital gain on the other side is totally different. Capital gain is an appreciation of a stock. So the companies with higher PE ratio, as we talked about it, they grow very fast. So your stock is going to grow very fast. X dollar stock can be 2x very soon, whereas low PE stock, they will pay you dividend, but the stock may not double as a company with a higher PE would.
It's kind of a company saying, thank you for believing in us. But not all companies pay dividends, right?
Yes, they don't.
Yeah. So when might someone prefer a capital gain instead?
So when might someone prefer a capital gain is a good question. So capital gain depends on the need. So for example, I want to take a vacation, I want to buy a house, I want to buy a car. So I want to invest in a stock for a short term, relatively short term, maybe 2 year, maybe 3 year, maybe 5 year. So at that time, I want my stock to grow much faster, and I can take the capital gain, which is basically by selling it, and then I can take that money and then do whatever I want to do, like buy a house, buy a car, go on vacation, or do whatever. So this is the scenario where I would take a capital gain, which is different than the scenario of dividend. Whereas dividend is I need a regular income on a monthly basis to buy my groceries and buy my things that I need.
So can capital gain be taxed?
Yes, capital gain is taxed. Capital gain is taxed in two ways. One is called short term. The second one is called long term. If you hold the stock more than a year, it's considered long term capital gain. And there are different slabs, 0%, 15%, 20%, and so on and so forth. 3 steps basically for long-term capital gain, and short-term capital gain is based upon your income. Whatever slab you're in, you have to pay income tax on it. So anything which is bought and sold within 1 year is short-term capital gain is triggered. Anything which is held over a year, could be 2 year, 5 year, 10 year, 20 year, a long-term capital gain is triggered. So they're both taxed in a different rate.
Right, capital gain can be taxed differently depending on how long you hold the stock. That's a key factor in planning your strategy. So wait, how can someone plan a dividend-paying stock and a growth stock in their portfolio?
So fundamentally, they're both different reasons why you want to use a dividend-paying stock and a capital gain stock. Like I said earlier on, a dividend-paying stock is your monthly need, day-to-day need, your income need that you need to augment your income with additional money. So you use a dividend-paying stock. Why you need capital gain is, like I said, you have a long-term strategy of buying a house, car, vacation, whatever. So you use that. How do you mix both of them? So when you're young, you don't really need income. So you need to focus on the capital gain. You need to put more money on the stock that's going to grow faster, that's going to give you money when you're retired or later stages of your life. But as you age, then you put more money on the dividend paying stock because you need income from it. There's many ways of many industry standard. One is primarily called 60-40, which is like 60% in stock and 40% in bonds. Some say based upon your bonds are the one that pays also interest, kind of dividend. So some says based upon your age you need to decide, but when you're young, then you need to put more in a growth or a capital gain stocks.
So I know we talked about the savings account in the previous episode. Can you tell what's the difference between a saving account and the capital gain?
Okay. So saving accounts basically give you a kind of fixed interest rate, and you cannot lose your capital. So whatever money you put it in your account, so it's backed by the US government, so you cannot lose. And typically bank offer, I think, up to about $1 million per account guarantee. Even if the bank goes bankrupt, then US government would pay you the money. So that is in savings. So they give you a fixed amount which is relatively small, and that is the saving interest. And you said, what was the
capital gain?
Capital gain, you're putting money in a company which is not backed by US government in terms of the what the company is going to be doing. So the company can go bankrupt also. So you could lose money, or the company cannot perform well. So the stock may go down or up depending on how company is doing. It's like a ship. If it's going through an ocean and you have a heavy wave or a thunder, then ship may not sail very smoothly. So the stock may go down because of that reason. A company is not performing well. So your capital can be lowered. Or you can lose it also if the ship flips. So basically, if the company folds it. So there is a risk to investing in a stock. Always remember that there's a risk to investing in stock.
That leads us into our next topic. We have talked about a lot about money growth. Let's talk about how to protect it. This means understanding your risk tolerance and why diversification matters. So what exactly is a risk tolerance, and how can someone figure theirs out?
Okay, that's an interesting question, because risk tolerance varies and it depends on an individual. An individual may be more aggressive. I'm sure you probably have studied type A personalities, type B personalities. So it's a very personality dependent topic. Some people are more risk taking, some people are less risk taking. So what are the things that you should do? If you don't want to take too much risk, then you put it, of course, in like a savings account, or buy US bonds or treasuries or utility stocks, which are more secure and established companies. They're not growth companies, they're not new. There's a history of it for 20, 30, 40, 50 year history, and that is where and remember that if you put it in a companies of that types or US bank, your growth is limited. You're not going to grow your money very fast, but at the same time your capital is pretty much secure. Whereas on the other hand, if you take risk, you could your capital can be at risk. You may be at risk of losing part of the capital or all of capital, but if it grows, you can be rewarded very well. Now, what to do in balancing? You could split it up, put some money in savings and bonds and some in high growth. So you can manage that. Like there's a saying, don't put all your eggs in one basket. It's a famous saying that. So you got to diversify accordingly, and there are many ways you can diversify within stock market. There are typically about stock market 11 different segments, like consumer, staple, consumer, necessity, real estate, financial, technology, communication, and then within each segment there are different variations. So you could do that.
Okay, so for example, a 17-year-old saving for college in 5 years would invest differently, saving for retirement in 40 years. Can you please explain diversification in simple terms for the audience?
Diversification in simple terms. Okay. Let me see. Like I said, not all eggs in one basket. So you want to secure. What is diversification? It's very difficult. Let me see. So like, let's say you're going to school, you could go in a bike, you can walk, you could go in a car. So you're going in different ways. Likewise, in the stock market, you put it in a safe stock, like utilities and all that. You can put it in a bank, which are also safe. So this is a diversification into, you're putting in a banks which are safe, or you put it in a high growth stocks which goes up and down very quickly depending on the market. So that'll be a diversification. You're putting some money in a, in a secure way like a bank or a utility stock, and some in a high growth stock. So that'll be your diversifying.
So you don't want to just put on all tech stocks. Even if you love Apple and Google, you may want to mix it up maybe with tech, healthcare, energy, and international stocks. So
Yes.
what might be the simplest way for teens to build a diverse portfolio?
So what is the simplest way would be, there's a thing called ETF, which is called exchange traded funds. And exchange traded funds, you get it for each segment, like you said. They get it for communication, the tech side, they get it for real estate, international. You can put some money in all of them. There are many funds, many companies like Vanguard and Fidelity Brokerage or Charles Schwab. They offer ETFs based upon your age also. They say if you're 15-year-old, this is how you should invest, or 20-year-old, or 30-year-old, and 40-year-old. So that would be a good way of diversification. They would do diversification for you. You say, I'm a 30-year-old, 20-year-old, and then they'll say, this is how your money would go. So that's the easiest way of diversification, and without taking risk, without knowing any detail.
So wait, are ETFs guaranteed, like money?
No, ETFs are not guaranteed. They're just like stocks. But I'm assuming that if you put an ETF, like for a 50-year-old ETF, there'll be big chunk would go in a bonds. Like I said earlier on, it's an age-dependent thing. Like if you're younger, then basically more money into the aggressive stock. So ETF, age-based ETF are the same way, but you could buy ETF of technology on your own. You can buy ETF of high tech. You can buy ETF of financial. You can buy ETF of real estate or consumer or whatever you want, but they're not guaranteed or safe 100%.
So what are the difference between ETFs and index funds?
ETF and index fund, they're pretty close. The key difference is index fund tracks an index. So what is an index? So Dow Jones, S&P 500 is an index. So the S&P, let's take an example of, instead of confusing or going over many things, let's take S&P 500. S&P 500 is a combination of 500 companies in Standard & Poor's. That's how S&P, the name, the acronym comes about. So they track 500 companies. So an index fund would mimic that. They would mimic the S&P 500. They'll track on those 500. Whereas an ETF is not necessarily ETF with exchange traded funds. So they would invest in, like I said, whatever the target of ETF is, then they would invest in that particular ETF. Whereas an index fund would try to mimic that particular index, the S&P 500 or Dow Jones or Russell 2000 or whatever the index is.
Okay, so you don't want, so that was a jam-packed episode, but here are some key points we went over. Do your homework, research your stock before you buy it, take advantage of Roth IRAs as soon as possible, know the difference between dividends and capital gains, and use both if you can. And most importantly, balance risk with diversification. If you could give any piece of advice to a teen that's just starting investing, what would it be?
Okay, so I think investing is a great idea. It's phenomenal. Like we talked about, compounding is like an eighth wonder of the world. Sometimes we don't understand the impact of compounding and investing, but in a later age, you would be thankful that you start to invest. So my advice would be to start as early as possible. and reinvest your dividend. If you're putting in a dividend paying stocks, reinvest. Don't withdraw any money. Don't withdraw money for, going out to movies, or I want to buy this clothes, or I want to buy a switch or whatever. So save that money. It'll be very helpful in your later age.
Thank you so much for joining us, Mr. Chanda, and thank you for listening to the Finance Capital. If you have found today's episode helpful, share it with a friend, and don't forget to follow us for more money smart content. Catch you next time. Until then, keep growing your money and your mind. Thank you.
Thank you.